A Fed-friendly CPI print and a market-friendly Goldilocks scenario. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. And you know what?
Yep.
This was not the reaction I thought at 8:31.
Yeah, but you know what? It's the reaction we got, and I guess some folks out there are loving it right now.
I mean, loving the risk-on rally. I mean, we're over 5,300 for the S&P. We're at a record high. The NASDAQ 100 at record highs. The Dow at record highs. The Russell near record highs. I mean, it is some serious green light for risk here. The 10-year yield is down 8 basis points. We're very close to the 200-day moving average. We're below that 50-day. We haven't seen this kind of move in the bond market since January, and the dollar is down. So you buy bonds, you buy stocks, you sell the dollar. That's the trade. I just want to point out something totally tangential, Romaine. We talked about this yesterday, and that's copper. Up again. We're at a record high for copper also, but that's more of a short covering thing. But it was a fascinating market evolution over the last 24 hours for copper.
Yeah, that squeeze continues in the copper market, and you go back to the broader market, at least for the stocks and bonds. And well, the bulls there, they actually got what they were hoping for today, and that really was that ebb in underlying U.S. inflation for the first time in 6 months. And that potentially could be the first brick in the groundwork for the Fed to cut rates this year. At least that's the hope. That hope propelling the NASDAQ 100 and the S&P to fresh record highs today. The Dow coming within about 13 points of its all-time high. The thought process here is pretty simple, is that after 3 straight months of hemming and hawing about an interruption in disinflation, the Goldilocks scenario that market participants had previously been pricing in, maybe that had been justified after all. Now, not everyone agrees, to be sure. Market strategist Ed Yardeni telling Bloomberg earlier today that a Fed rate cut right now could actually disrupt that Goldilocks narrative, leading to an even longer battle with inflation. And Bridgewater Associates CEO Nir Bardea, he was speaking at the Qatar Economic Forum. He said there's still a ways to go before the Fed gets inflation under control. And even if it does, it'll be a delicate dance for the central bank to pull that off. Now, a lot of the euphoria today over the CPI print is less about the print today. It's really more about the 3 consecutive upside inflation surprises we had in the months prior. Kathy Jones, Charles Schwab's chief fixed income strategist, put it best. She says it's going to take a few more disinflationary readings for the Fed to act. But the snapping of that streak today of 3 consecutive above forecast readings certainly opens the door to a potential rate cut later this year, Alex.
And the question is, like, again, how many? When does it start?
Yeah.
But then does it matter? I mean, I feel like whether you get 2 or 3 and when it starts, it's still like green light, risk on.
Yeah, pretty much.
So let's take a look. Let's take a look at where we are. And this maybe is why we're green light, risk on, right? This is where we were for over 7 cuts priced in. That was back at the end of last year. And now look at where we are. We're right around 2 now. We picked up a little bit after that CPI, but we're still at about 2 cuts. The market's looking a little bit like September. Maybe we get those cuts. But the idea is we're going to get some maybe this year. But if we didn't, would it be that big of a deal? I mean, just the market reaction and sort of the enthusiasm towards these record highs after record highs. And it's broadening out, Romaine, with the Russell, for example, doing really well today, too. You have to ask, like, is it a green light until something bad happens?
Yeah, well, it's interesting. We take a look at the data here, and maybe that gives some people some hope that that green light is up ahead. Let's get some thoughts out of our first guest. Kicking us off to the close today is Yelena Shelyacheva, senior U.S. economist over at BNP Paribas, joining us live from the sidelines of a big global conference they're having right here in Manhattan. And Yelena, let's start off with that CPI report. We had the similar story here. Goods prices, that continues to see disinflationary trends. We're seeing softness on the services side, but we're still seeing a lot of persistence when it comes to shelter costs. What did you make of today's report?
Well, first of all, I'm really happy to be here at Casa Cipriani's 7th annual Global Markets Conference. And a lot of investors and participants are asking the same exact questions as you are, Romaine. Is inflation really on the right path? Our read of the data is that it is. It is finally starting to cooperate, particularly, I would say, on the shelter front. I think today's data is really the right step in a series of steps that we are forecasting that shelter inflation will continue to subside.
Yeah.
We are a little bit worried about goods disinflation or deflation being more or less over, but services inflation will need to start cooperating as well. And I think we will see some further disinflation this year. Having said that, I think it's really going to be very slow.
Yeah.
So policymakers will have some time to digest it, and they're not ready to cut rates just yet.
Well, that's ultimately the question here, Yelena, is how the Fed reacts to this data point and maybe the subsequent data points here. I know actually down there in Lower Manhattan, you're going to have a chance to sit down with some former Fed members like Bullard and a couple of others. I am curious as to what you would ask them. If they were still making decisions, still voting members on the committee, do you think they would go into at least the next meeting with a serious and tangible discussion about starting at some point this year, a rate cut cycle?
Well, it will depend on the policymaker. So here we are hosting Mr. Bullard, Evans, and Ms. George. So they obviously in the past had different opinions, particularly with respect to inflation and inflationary pressures. But I would say that the consensus on the committee is such that they really want to see more of this data on inflation to really seriously consider the start of the cutting cycle. I think this one print and even 3 more is probably not going to be enough for them to make such a decision. I think it will require multiple inflation readings going forward. And what else I would say is that the election process will kick in later this year. And if you're a policymaker, how are you going to consider, how are you going to put that into account? If you're sitting at the board table and making the decisions about the next policy move, you really need to know a little bit more about economic outlook. And that economic outlook will really depend on who wins the election, what's the outcome of the congressional election as well.
Yelena, bravo for getting through that with a loudspeaker. I've been there, and that's really tough. What continues to confuse me, though, is the conviction that financial conditions are tight enough. Kashkari raised the question today that maybe they aren't. They need more of a wait and see. What's your conviction that financial conditions are tight enough?
Well, the economy is growing, and despite some recent, data, particularly on the survey side, right, pointing to some, discouraging signs that maybe hiring is going to slow down. Activity data is still very strong. The first quarter GDP data was very strong, and despite today's negative surprise on retail sales, consumers are still spending, and they're still spending at a very solid pace. So I expect that to continue this year. And our projection is for solid growth in the vicinity of 2%. So in that sense, policy is restrictive. We do see some slowdown, but I don't think it's really that restrictive to arrest economic growth to such a degree that it will require immediate action by the Fed.
So does that mean so what does higher for longer then mean for you? What's that timeline?
Well, that means we still believe in our projection for the Fed to start the cutting cycle in December. And patience. And that has been reflected in a lot of Fed speak recently, like from the chair himself to the vice chair and, their colleagues as well. So the message is still the same, higher for longer, and patience.
All right, Yelena, always great to catch up with you. Have a great time down there at the conference. Yelena Shelyacheva, senior U.S. economist over at BNP Paribas, helping us kick you off to the close here on this Wednesday afternoon. Coming up here on the big program with graduation season afoot, that whole cohort of Gen Z entering the workforce says bye-bye to 9 to 5, and they are embracing freelancing. A conversation up ahead with Hayden Brown, president and CEO of the freelance platform Upwork.
Have you ever worked 9 to 5? Mm-hmm. You have? I definitely have not. All right, the green light for risk assets. That's the main conversation with Bruce Richards, chair and CEO over at Marathon Asset Management. He's feeling optimistic where he's seeing the opportunity. And one of the hottest stocks yesterday was Plug Power. That's off the back of that news of a $1.7 billion loan commitment from the Department of Energy here in the U.S. A conversation up ahead with the president and CEO, Andy Marsh. Stick with us. This is The Close on Bloomberg.
About 38% of the workforce here in the U.S., or about 64 million people, performed freelance work last year. The generation taking the lead, well, who else other than Gen Z? A new study out of Upwork finds that new grads are increasingly rejecting 9-to-5 jobs and fully embracing freelancing as a career choice, with more than half of Gen Z freelancers finding at least 40 hours of work per week. Joining us to talk a little bit more about this is the president and CEO of the freelance platform Upwork, Hayden Brown. Hayden, great to have you here on the program. I was really fascinated by these statistics. I mean, just the idea that basically more than half of these grads are basically working what is basically the equivalent of a full-time job, but doing it in a freelance way. Is this kind of a one-off blip because of labor market conditions, or is this more of a, I guess, longer-term structural trend?
Romain, thanks for having me. This is an enduring trend. We've seen increasing data showing for many years now that freelancing is a career of choice for every successive generation of workers. And Gen Z is showing us that they are opting into this way of working at the highest levels that we've seen yet. And again, we saw before the pandemic, more and more workers wanted to work this way. Through the pandemic, those numbers increased, and now it's at a fever pitch. But this is because people want freedom, they want flexibility, they want to be their own boss. And increasingly, the technology that's available through platforms like Upwork, through remote collaboration tools, through everything we do with Zoom and everything else, makes it possible for people to build a career this way and really make it sustaining and really bring the income and security that they're looking for.
I am curious. I understand exactly why workers want this, but are the companies, the ones that are doing the hiring, are they still receptive to this? It seemed like they were willing to extend that type of flexibility a couple of years ago, but we've seen so many stories over the last few months here about how they really want everybody back in the office 5 days a week.
It's a great question. And actually, companies are waking up to the fact that not only do they need to work this way, it's actually a preferred way of working because of a few things. One, they have to access talent that they need through this way of working. If they want to get Gen Z professionals, if they want highly skilled professionals, they've got to turn to the freelance workforce to get those people. They've also realized, and I'm sure you talk to every company who comes on this program who's looking at margins, who's looking at agility that they need in their workforce to flex up and flex down based on projects, based on economic conditions, that having a flexible freelance workforce is actually hugely desirable and a huge asset for businesses in economic conditions that continue to change, and frankly, because business priorities are always evolving. So for all of these reasons, businesses are realizing it's cost effective, it's flexible, and it gives them everything they need in terms of tapping into the talent that is here today with the skills like AI and other things that they're looking for.
Hayden, how much of that do you think is due to the fact that we've had a loose labor market? And if we get a tighter labor market, does this setup change? No, flip it. Tighter labor market and then looser labor market. That's what I meant.
We've seen that the increases in demand from both clients and professionals to work with freelancers and to work in the freelance economy have actually endured and increased irrespective of economic conditions. During economic downturns, when we talk to freelancers, they say they're actually preferring to work this way because it buffers them from the risk of layoffs and it makes them feel much more economically secure. You talk to clients in those times and they say they love working with freelancers because it gives them flexibility in their economic model. At the same time, when the economy is improving or is really robust, companies love working this way because it's a super fast way that they can tap into the talent they need, and they're not laying cement. They have the flexibility to continue to be dynamic. So really, irrespective of economic conditions, this is an enduring trend for both sides of the equation.
And I know this is maybe a softball question, but how is that viewed on your website? Like, how much more traffic have you realized? Like, how have you optimized and sort of catapulted off of that?
Sure, Alex. This has been a growth business for Upwork. I mean, we've been doing this for 20 years. We're kind of the experts at this. And I think what's exciting for our business is we continue to see a lot of growth on both the demand and the supply side of the equation. For us, the demand side is clients. And this past quarter, for example, we saw a 5% increase in clients year over year, which is actually the strongest demand that we've seen increasing from clients in the last couple of quarters. So this is increasing for us right now and is going to power us through coming quarters. We also see a lot of growth on the enterprise side. This is today about 20% of our business, but increasingly large enterprises like Microsoft, many others, NASDAQ, are coming to Upwork and building enduring freelance programs because they know this is a way that they've got to work, not just now, but permanently using this freelance workforce.
Well, this gets to a broader question too, Hayden, about the future and particularly how AI gets integrated into that. Either it's going to be the best thing since sliced bread or it's going to take all of our jobs. I assume there has to be some middle ground there. And I am curious as to the companies that are using your platform and more importantly, the job seekers who are using the platform. How much is AI integrated into that strategy?
AI is a huge theme for our business and for the talent that's using our platform. And so it shows up in a few ways. One is certainly on our own platform, we've been launching AI-powered technology. We have Uma, which is an AI work co-pilot that really helps both clients and talent get work done on our platform. And so this is a transformational way that we've started to unlock faster and easier ways to actually get work done. But to your broader question around AI, replacing workers or work versus augmenting, what we're really seeing is AI as a tremendous augmentation tool. Across our platform, 54% of talent are already using AI tools on a weekly basis, and it's really accelerating productivity, earnings for them, and we're actually augmenting their work with partnerships with companies like GoDaddy, Dropbox, OpenAI, and others to really put the tools in their hands to be giving better solutions to their own clients every day, because clients are saying, we need workers who know how to use these fast-moving technologies, and we can't upskill our internal teams fast enough. At most companies, 9% of workers are using AI tools, whereas on Upwork, more than 50% of these talented freelancers are already adopting these tools, which is a huge differential and a benefit for our customers.
All right, Hayden, thanks a lot. Really appreciate it. Thank you very much, Hayden Brown, President and CEO over at Upwork. Just keeping our eye here on Netflix. That stock spiking off its session lows is going to be launching an in-house advertising platform. It says its ad-supported plan has 40 million users. I have to say, I would definitely pay for no commercials.
Some of the data that they're giving out here is pretty impressive here. We talk about Amy Reinhardt. She's speaking right now at an event in New York. Ad plan subscribers up 40% of the signups, make up 40% of the signups right now. She also says that overall, that's up 5 million from a year ago on the 40 million. And remember, when they had their earnings, there was a lot of questions as to why they weren't disclosing more numbers about the ad platform. And I guess these are the numbers that we all wanted. I mean, just on the surface, this looks pretty darn good.
Yeah. That is pretty darn good. And it gives them a little breathing room, too. Anyway, Netflix is up over 1%. This is Bloomberg.
All right, let's get a view from the sell side with our top calls. Big movers on the back of analyst recommendations, and we start off with Six Flags. Deutsche Bank cutting the amusement park company's rating down to hold. The analyst does say he's confident in the company's planned merger with Cedar Fair, but says buying the shares of Cedar Fair is his preferred way to gain access to the expected benefits of that acquisition. A bit of a flip-flop there, sending the shares down about 1% on the day. Next up, let's take a look at SunPower. Cut to underperform over at Wolfe Research. This after the resurgence of meme stock frenzy sent the shares up 91% over the previous 2 days. The analysts, though, not seeing any positive developments at the solar energy company, which still needs more capital to deal with the dismal outlook in its biggest market of California. The analyst says that once the short squeeze is over, expect the stock to come back to reality. It appears that's already happening with the 28% drop here on the day. All right, and let's end things now in the consumer staples space. The folks over at Bernstein lifting their ratings on Campbell Soup and General Mills to market perform. Analysts led by Alexia Howard expecting improvements in volume growth in the second half. The firm also cites low valuations, but says performance can improve if the sector benefits from pricing for foods associated with cooking from scratch. Those shares nevertheless down about 1.5% on the day. And those are some of our top calls. But we do want to stick on that last call because I'm pleased to say that the analyst behind it is joining us. Alexia Howard, Senior Research Analyst covering U.S. food over at Bernstein. Let's get right to it, Alexia. When we talk about a potential rebound in the second half, and if that is volume-based, what exactly is driving that uptick in volume? Is that greater demand, or is this more a function of shifts in pricing?
It's a little bit of both. I think the sector has been through a roller coaster ride the last few years, very strong demand during the pandemic. Obviously, we had weaker demand as we went through that incredible inflation a couple of years ago. And frankly, last year was abysmal because of a number of factors: weak innovation, concerns about the GLP-1, the Ozempic and Wegovy factors weighed on the stock multiples. But from a volume perspective, the stimulus spending really started to flow out or get weaker last year, and that also weighed on the company's volume results, I believe. But the most important factor, I think, was cooking from scratch last summer, as you rightly pointed out. Prices on single ingredient items like meat and produce and dairy products, even dry pasta, started to fall around about June, July of last year. And I think that drove a lot of more vulnerable consumers into cooking from scratch a lot more. We're going to be lapping that over the next couple of months, and hopefully that will lead to better volume trends.
But on that point, too, particularly about the consumer that maybe is being a little bit pinched, looking for better options, there was some concern, particularly coming out of the last earnings cycle, Alexia, that a lot of those consumers are also trading down to generic brands, so going off-label instead of buying the Campbell's branded or the General Mills branded foods here. Are you seeing that, or is that kind of maybe a little bit overplayed?
I think we're seeing a bit of that, but it's not been really pronounced. It was very interesting that supply chain problems really caused those generic products to have problems during the 2022 year period. I would say at this point, there's a little bit of that coming back. As we say, the vulnerable consumers are trading down a little bit, but I don't think that's the main story here.
So how do you then see the outlook for demand? Because a lot of companies we do talk to, like Mondelez, for example, do see a value war unfolding.
Yeah, so I think that at the moment what we're seeing is packaged food. We've definitely seen a slowdown in restaurant traffic. So that, in theory, should boost sales of food at home. And I expect that over the next few months, as we start to lap that cooking from scratch step up that we saw last year, things will get a little bit easier for the branded packaged food players. So I'm not expecting a massive return to super positive volume growth. I'm basically just saying that those mid-single digit declines in volumes that we've seen for the last couple of years will probably start to improve sequentially. And that's obviously going to be a better trend than we've seen over the last 18 months or so.
Margins, improvement anywhere?
I think we are seeing margin improvement here and there. Obviously, we went through that incredible inflation 18 months ago, and we did already see some nice rebounding on the margin front. As we continue to see the input cost pressures ebb away, labor costs also getting a little bit easier at this point. I rather suspect that with a bit of operating leverage and with ongoing productivity improvements, the companies will see some margin improvement, not necessarily as big as it was last year.
All right, Alexia, thank you very much. Alexia Howard over at Bernstein, thank you so much for joining us. We also love your tablecloth, by the way. All right, let's get back to that breaking story. Netflix announcing its monthly active users of its ad-supported subscription plan has reached 40 million. And that it will launch an in-house ad technology platform to support this part of its business. We want to go to Chris Palmieri of Bloomberg News. He joins us now for more. Hey, Chris, well, what do we make of this? This seems like a very big number.
Yeah, it is more than double what they started the year with, and up from just 5 million a year ago. The ad-supported plan got off to a slow start. There was a lot of question marks about it, but it now has become a sizable part of their business. So 40% of the new subscriptions in the markets where it's available are coming to the ad plan.
I am curious here when we talk about the growth of this, Chris. I mean, when you see just how quickly it's sort of stabilized, and the idea that most of the new customers, not most, I think it was like 40% of the new customers now are coming in through that platform. What does this mean for those tiers as a whole? Do you think there could be a reassessment of whether you even need some of the other tiers still?
Well, they're already phasing out one of the tiers. So they basically have the ad-supported one, the mid-price tier, and then the premium one. And that's their model. And we're seeing this whole movement in streaming land with all these bundling going on. And usually that comes at a discounted price as well. So, that's sort of the big story this year, bundling and ads. This is, when the upfronts are being sold in New York, all the big TV networks are there presenting their shows. Netflix is part of that today, and advertising, it's sort of going back to the way TV used to be. It's become an ad-supported medium.
All right. Thanks a lot, Chris. We really appreciate jumping on with us. Thank you very much. Bloomberg's Chris Palmieri joining us. Netflix is up over 1%. I gotta say, guys, we are still in a very big green light rally. It is full on risk on. You buy stocks, you buy bonds, you sell the dollar. That's kind of the takeaway. We're over 5,300 for the S&P at a record high. Bruce Richards, CEO and chairman of Marathon Asset Management, currently has more than $23 billion of capital under management. Joins us now. Bruce, good to see you.
Hi, Alex.
What do you make of this?
Well, good CPI numbers today. Why? For two reasons. Number one, the market came in short, and so technically they were short. And so anything that came in on expectations, the market was going to rally. We saw it in treasuries, and we saw it in equities, and it's a big rally. The second reason is CPI, when you look at fundamentally, the numbers were pretty good, 3.4% on expectations. But when you look at the trailing 3 months at 4.1%, which is the last 3 months on average, that number still too high for the Fed. So it means higher for longer without a doubt. And you see goods inflation. You saw it with retail sales, but goods inflation a little soft. But the services and OER, which is owner equivalent rent, up around 6%, still too high, too firm. So I think it was perfect because for us bond guys and credit investors, it's Goldilocks, it's higher for longer, and we're making a lot of money off these higher rates. So and for the equity folks, the technicals are driving it, and the animal spirits are out.
So, okay, but you've been saying this for a while, the golden age for credit. You like lots of different things. Yes. Well, you have a favorite area of credit? Do you have an area that you don't like in credit?
Well, it's kind of like, and that's why I call it Goldilocks, because you look at the liquid credit markets, which is everything from high yield loans. They're ripping, nearly half of the high yield bond index is trading inside of 200. 62% of the leveraged loan index is trading above par, so that's doing really, really well. Structured credit is crushing it. ABS, RMBS, CMBS, and CLOs. Yes, even CMBS is having a good run here, despite what's happening in commercial real estate. And then emerging market debt doing well. So in the liquid credit markets, which is like a total of 12 trillion, it's all doing really well. And do I have a favorite? Well, we are very selective in our bottom up in terms of what we invest in. And there's a lot of value right now, particularly in the structured credit sector compared to these other sectors. In private credit, it's, middle market lending, direct lending, it's asset-based lending, which is huge and going to get much, much bigger. And there's a lot of opportunities in capital solutions. So it's kind of Goldilocks for all credit, generally speaking, but there's a small cohort that is the tale of two cities, the other part that's struggling under these higher rates.
Is there any sort of correlation with those pockets and the areas you're talking about?
Well, there's correlation among commercial real estate, of course, remain. Yeah. And so, the banks are going to be very, very constrained because these new CRR, capital requirements under Basel III Endgame comes in, and it means you really have to lower down your LTV to make that same loan, or you're going to have a big capital charge. And so that's when private credit is going to lean forward and make loans. We've been very active there as banks pull back from extending commercial real estate loans. And the second part are companies that are just a little bit too levered, right, that need capital solutions. And then again, we're leaning in. And look, talking about leaning in, what's the big lean in? You got to look at Keith Gill and you got to look at the Roaring Kitty and just see that lean in. But the real Roaring Kitty, Jay Powell. And why I say that is because as of last October, with his words, he's been leaning in. And the equity market since last October, up 10 trillion. What did Keith bring to the table? He brought, GameStop, AMC, like 10 billion of value.
Is that
the Fed chairman and his litter? By the way, his litter is all the congressmen,
We're going deep in this analogy now.
Who put trillions of dollars of stimulus and has enabled the economy to be as strong as it is. And so that's the real Roaring Kitty. It's Keith, but it's Jay Powell is the big guy.
Do you worry at all, though? I mean, it's one thing to have a Goldilocks scenario where things are kind of stable, but when you start talking about kind of what we saw based on that Roaring Kitty tweet and all the animal spirits come back in here, does that not worry you that if we get to the stage of that euphoria again, then maybe that means Jay Powell then leans back in his chair and says, Bruce, settle down?
I think we're a little way away from that. I mean, we've been leaning into, say, AMC. So we're long AMC for like a year, 2 years, 3 years. And when you lean in and AMC goes running up, there's a lot of equity that the company can now raise, and that goes right into our pocket because we're earning 15%, senior secured, leaned up against all their assets.
And they already did that.
We're debt with debt protection, and we're earning 15%, thanks to Roaring Kitty and all the meme fam club that's buying up AMC.
So the debt issuance that we had announced yesterday by AMC, you think we're going to see more of that from some of these other stocks?
Oh, absolutely. When you raise equity, you raise that, and it's a combo platter trade. And we're long, kind of the senior secured stuff that we bought in the 60s, that went to 70s, the 80s. They're now in the 90s, but we love them still in the 90s because we're earning 15% yield on that at a discount with all that equity cap that backs it now, and in a senior secured position.
I love that for you.
I love it for us.
Yeah, I
and
bet
our
you
investors.
do. What else do you like right now? What else is speaking to you?
Well, what's not speaking to me is treasuries. I think treasuries are kind of in this range. It's 4 to 4 3/4. I think is the inside range. 3 3/4 to 5 is the outside range. I think that R star is going to be high enough, and all the massive treasury issuance. So I'd be fading treasuries when it gets to, not today, but when it gets to like inside of 4, and I'd be a buyer kind of like in the 4 3/4 neighborhood or anything wider than that.
Do you not think we would break out of that range?
I think we're going to be in that range for a really long time, and I think you fade either side of that. And in credit, buy it. And you buy it in liquid credit with multi-asset credit strategies, and you buy it in private credit with both middle market lending, asset-based lending, and some of these opportunistic strategies. Credit is the place to be. So private equity, right, done very well for a very long period of time. Private credit, which has a fraction of the risk of the leveraged private equity, fraction of that risk, because we're senior to it, right? And we have our fixed coupon that, and floating rate coupons that underwrite that cash flow, right? We outperformed that index of private equity last year, and the same thing will happen again this year. So I think allocations to equity has always been the rage, balanced with like maybe some hedge in treasuries. But now you can really balance a portfolio with credit because it yields so much, and you don't have to take the equity-like risk. So I like equities. It's broad-based now, right? S&P's up 11,
does that
Nasdaq's up 11.
Credit, does that replace what you would maybe have in, say, in government bonds, or is that complement that?
I think it can come from different pockets. I think every plan manager, every asset allocation model can think about it differently. They can think about it on the alt side for private credit versus their other alts. Like, why should I have alts in real estate equity when I can have real estate credit that yields a lot more, that's sucking out all the cash flow from the properties, not allowing the equity owners to participate? The same thing happening in private equity. You can start to balance that out a little bit, or you can take from your high-grade portfolio, whether it's governments or investment-grade corporates, and go down in credit because the economy is doing well, and and companies' capital structures are so well established at this point in terms of being able to service the debt.
You sound so bullish. Everything is green. Everything is positive. Treasuries are range-bound. That's making me nervous.
Well,
why shouldn't I be nervous about that?
The thing to be nervous about is the U.S. government.
I'm always nervous about the U.S. government.
So am I. Issuing so much debt and running such massive deficits. And some point, there's going to be that crowding out there. But right now, you don't fight the Fed. You take what they have at you. And in a strong economy, when corporate earnings are doing well, and so it's really good for credit, and in a high rate environment, you don't want to be leaning out right now. You want to be not that roaring credit kitty, and you want to buy value, and you want to have it well structured. You want to have all your protection in place. You want to know you're going to get paid your par plus your accrued. But you do all this fundamental work, and you put that money in the ground and just let it work for you.
All right, Bruce, going to have to leave it there. Always great to talk to you. Bruce
Thank you,
Richards, CEO, Chairman of Marathon Asset Management. Stick with us. We'll be back in a moment, right here on The Close on Bloomberg.
Time now for Stock of the Hour. We're taking a look at Plug Power after yesterday's monster rally. The Department of Energy granting it $1.7 billion in loan guarantees to bolster green hydrogen development in the U.S. Joining us now for more on this, fresh off the plane, Andy Marsh, President and CEO of Plug Power. Hey, Andy, congrats on the money. I know it's conditional, but I know it's much needed. How much time does this give you until you have to kind of get more capital, maybe go back to the market, et cetera?
Sure, Alex, look, we are, probably will be, we have a very strong balance sheet, but not as liquid as we would like. And I can tell you we've been looking at debt solutions to leverage our restricted cash. And if we're successful at doing that, I don't expect to have to go into the market very aggressively, over the coming year. But key to us is actually closing a debt deal. And we are working on it, and I think it will happen.
And a big part of this, Andy, is not just sort of building out a green hydrogen facility, which of course the government loan will help with, but also getting the end user demand. What's that like? I've been hearing from a lot of people that they're buyers, they're sellers, but the price just isn't there right now, and it's making that kind of business really difficult.
Well, Alex, it's one of the reasons that we have focused on building our own hydrogen plants. I think a lot of times it's the price, but it's not the cost. Our Georgia facility, we feel we can be producing hydrogen at a very, very competitive cost with gray hydrogen. And we're unusual. We actually have customers who are using our products today, and I have to buy hydrogen from third parties to sell them. With the plants we're building out, using our fuel cells, we'll be able to provide our customers competitive price hydrogen directly. So it makes things a lot better for them, and it really helps create a opportunity to build out this economy for hydrogen more rapidly. And I think that's why the DOE found it exciting and interesting to work with Plug, because we've already built a plant. We showed we know how to do it. They spent 2 years doing due diligence on us and came to the conclusion we were a good investment.
So give me a sense here, Andy, because when we talk about your point here about bringing those prices down, that's obviously a big component of this. I forgot what the target was that the Biden administration has, but it was something like getting it down to like $1 or something per kilogram here. How realistic is that for the timetable they laid out to get to that by 2030?
So the real question is what's the cost? So if you look at the cost of our hydrogen plants, it's closely tied to the cost of wind and solar and renewable energy. And the closer that price comes to 2 cents to 3 cents a kilowatt hour, it is realistic that you can get down to $1. And that's really the key. You have to improve the efficiency of the electrolyzers. And the government actually supported us on that with grants of over $40 million to improve our manufacturing and to do some development to really drive down the costs of products. I mean, one of the things that the Biden administration should get a lot of credit for is how they built out this really wide vision of what was needed to build out the hydrogen economy. Between technology investments with the $750 million they put out, with the PTC, which allows a price reduction for green hydrogen or low carbon hydrogen, as well as when you look at activities associated with the hydrogen hubs. And, I put it all together, and it really does allow the U.S. to be cost competitive by 2030. I was in Rotterdam yesterday at a conference with 5,000 people in the hydrogen industry. And one of their biggest complaints in Europe is how aggressive the U.S. is about being a leader in this industry. And I think the right things are going on between companies, governments across the board.
What about jobs, Andy? When we talk about the potential job creation that comes out of a project like this, are you anticipating having to do significant hiring?
So when I look at our plant in Georgia that we built, which is probably 1/10 the size of what we plan to build out with these 6 projects, we had people work 1 million hours to build that plant. Good construction jobs. And so I would expect good construction jobs at all these plants, plus good jobs for folks that are working there, as we have in Georgia and Tennessee today. Plug employs over 2,000 people almost in upstate New York, which is a real oddity. And this building out the industry really will help create good, clean jobs in the U.S. and allow the U.S. to be the leader in this industry.
Hey, Andy, thanks for jumping off a plane and talking to us. Andy Marsh, President and CEO of Plug Power. Romaine, that stock is up like 40% just in the last day, but well beyond its peak that we saw in 2023.
Yeah, it'll be interesting to see how this money gets put to use here. Of course, there were a lot of questions here about the future, the health of the company itself here. Is this more than just a lifetime? Is this really kind of the platform for that transformation that I think Andy is counting on?
Yep. And what happens if we have a change in administration in November? What happens there? All right, coming up, we're going to count you down to the closing bells with Heather Brilliant of Diamond Hill. This is Bloomberg.
This is the countdown to the close. Romaine Bostic alongside Alex Seal. 10 minutes until we get to the closing bells with the S&P and the NASDAQ right now trading at record highs.
Yep, that's pretty much it. Record. The Russell's not at a record, though, off the highs of the session, but nonetheless. I did want to point out AMC, though. So the meme stocks are kind of rolling over a little bit, but you got to give AMC credit, right? They issued some shares. They did a debt for stock swap. Like, they did the stuff they were supposed to do after a 3-day nice rally within their stock for no reason.
Yeah, a little bit of a pullback today, and maybe that is based on, I guess, well, people waking up to the reality of valuations. Though there has been a lot of talk here about macro conditions as well. We had a chance to catch up with Bruce Richards over at Marathon. We asked him about the CPI print earlier today and what it means for the bond market going forward.
Higher for longer, without a doubt. And you see goods inflation. You saw it with retail sales, but goods inflation a little soft. But the services and OER, which is on an equivalent rent, up around 6%, still too high, too firm. So I think it was perfect because for us bond guys and credit investors, it's Goldilocks, it's higher for longer, and we're making a lot of money off these higher rates. So for the equity folks, the technicals are driving it, and the animal spirits are out.
Bruce Richards over at Marathon. As we count you down to the closing bells, let's bring in Heather Brilliant, CEO over at Diamond Hill, joining us here in Studio 2 in New York. Great to see you in person.
Thanks for having me.
I am curious. I mean, we heard from Bruce. He was just giddy. I mean, he's a bond guy critic. I mean, they always think, that the world is their oyster here. But I'm wondering, when you look at economic conditions and you look at some of the data points that we've gotten, including a relatively encouraging CPI report today, I mean, how does that feel for you as an equity investor, more importantly, as a bottom-up equity investor?
Yeah, I mean, we really focus on valuation. And so overall, with the market kind of broadening out over the last couple quarters, what we're seeing is a market that's pretty fully valued. And so it's getting harder and harder to find ideas. I think, if you look at the S&P 500 trading at around 21 times earnings, that's a reasonably full valuation. And so we have to dig more and more to find the ideas that we can invest in.
There has been a lot of talk about overall valuations, I mean, on the indexes. And we talk about an S&P, a NASDAQ, and I just was checking the Dow also at a record high today. And if you look at some of the PE ratios, price to sales rates, some of the other metrics at the top line, they are elevated.
Yep.
However, there are a lot of stocks within those indexes that are below their historical averages. So there is value out there.
Always.
What's holding people back from buying that?
I mean, I think right now people are worried about the economy, and maybe, the data from today will make people feel a little bit better. We'll see. Yeah. But overall, I think we are finding opportunities where the market or investors are concerned about companies that might be more economically cyclical going into a period of greater economic uncertainty. We do eventually have to have some kind of recession. No one knows exactly when it will come, but I think that kind of holds back the valuations of some companies for sure.
So what's one of your top picks right now?
So one of the companies we really like is Abbott. Abbott is one that has done, they fundamentally did really well through the pandemic because they had the tests that we all use to verify whether we had COVID or not. And as some of that revenue has been coming off, it kind of obfuscates what's going on in their underlying business. But on an underlying basis, we think that the investments that they've been making in medical devices and pharmaceuticals, their R&D has been really productive. They've come out with a lot of new products. And so we think the prospects are really bright for that.
So then based on that, though, what about all the issues with, say, GLP-1s, et cetera? Like, if that's the AI of, like, biotech, if they don't have a leg into it, are they just not going to get a nice valuation pop at some point?
Well, I do think as a fundamental investor, we're really trying to look for ideas that don't need a valuation pop to be successful. And so companies that are returning capital to shareholders, either in the form of buybacks or dividends, where, even if their valuation, their multiples are the same 5 years from now, will still have done very well as investors. Because I think that the multiples are getting so unpredictable, we don't want to have to rely on that as much.
I am curious, too. I mean, there are a lot of stocks that fall into that category. And these are particularly stocks that got hit hard during the pandemic and never really kind of caught up with the latest rallies that we've had here. And I saw one of the names that Diamond Hill had out there that you're hot on is Cisco, not Cisco, the networking company,
right.
but Cisco, the food service and uniform delivery company. Explain that to me.
Yeah, so that's another one where I'd say they have a little bit more exposure to the economy. And so where we've seen some softness going on in especially some of the fast food restaurants. And Cisco has some exposure to that, but not a ton. It's about 25% of their business. Fundamentally, we think it's more of a economically sensitive, but not overly sensitive company that benefits from being kind of in the middle as a distributor between the producers of a lot of food products and the restaurants and suppliers that need access to that. And so they've kind of created a competitive advantage by being the middle person between those two parts of the market. So,
do you feel like you're seeing more like real stock picking, fundamental stock picking? I mean, there was a lot of talk these last 2 days over GameStop, AMC, and all these meme stocks rallying on whatever they're rallying on. Certainly wasn't fundamentals, but it sort of, I think, sort of reminded everyone of kind of that last big leg of the bull market where it really was just hopes and dreams and everybody was just buying whatever they thought would go up and, damn be the fundamentals here. Are you seeing, though, more of your cohorts and more of your peers maybe returning to the fundamentals that probably they learned in school and they learned when they first started out on these trading desks?
It's really hard to say whether our competitors and our peers are looking at that more. I mean, I think we all hope that eventually cash flows and stock prices will have something to do with each other again. And, really for us, it's more than a hope. It's our expectation that over the long run, that's how it has to work. So
you also like Glencore, which I love.
Yes.
And it's a great story because the copper market is very structural and cyclical all at the same time. Huge structural change, but still in a cyclical market. Do you like it at these levels still?
Yeah, we do, actually. I mean, I know copper's been rallying, especially in the U.S. lately, the last couple of days even alone, but that is all more opportunity for Glencore. And honestly, when we look at it, we're looking at such a long-term perspective. Does Glencore have the resources to fund the development that they want to do in copper over the long term in order to meet that long-term demand? And we think they do, between their assets in coal and the way they've made investments on the copper side. So,
what don't you like right now? Like you're actively like, no to this.
I mean, I think they're GameStop.
Okay. When was the last time anyone was in a GameStop?
So you're leaning back in your chair, not leaning forward as a roaring kitty.
Yeah, I mean, I'd say we're really looking to avoid companies that are overvalued. And we even have a long-short strategy where we'll short names that we think look incredibly overvalued. And so those are still opportunities for investors. They're just opportunities in the other direction.
All right, Heather, going to have to leave it there. Great to see you in person. Heather Brilliant there, the pride of Northwestern University, and more importantly, the CEO over at Diamond Hill. More than $20 billion in assets under management, I believe, here. As we get to those closing bells, Alex, here, and the three major indices right now in the U.S., the Dow, the NASDAQ, and the S&P right now at record highs.
Here's my question. Now what? Do we wait for NVIDIA for confirmation of AI for next week or what? What's going to be the catalyst?
A big question is, I guess, what's the catalyst that drove this? Was it on corporate fundamentals or was it, the hope that now rate cuts are back in play? I have a feeling that might be more of what's driving the rally. Whether they get that or not remains to be seen. We get some earnings tonight, too, as well, from the other Cisco, not the one that Heather was talking about.
Not the napkin Cisco.
So get ready as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast. We're joined right now by Scarlett Fu in the TV studio. There's Alex Steele. There's Carol Masser in the radio booth. And I believe, finally, Tim Senovic is back from his long vacation. So we got the whole gang back together. And you come back on a day where we got record highs across the board here.
Yeah, go figure, right?
Yeah.
Everything is awesome, as we like to say. We're seeing some buying. It looks like a little bit into the close here. I keep looking at the semiconductor space, guys. Up 1.7% yesterday, up another 2.9% today. So it continues. I think we're actually up about 4 days, here in a row, 3 or 4 4 days in a row. So the momentum certainly in that space continues outperforming even the broader market, it looks like.
Even though we're seeing records likely at the close for the S&P 500 and the NASDAQ, we just spoke to Luca Paolini over at Pick Day, Scarlett, and he said in the short term, he sees a rotation to Europe and Japan as being a good value for investors. In the long term, though, the U.S. is still the place to be.
Yeah, but maybe valuation-wise, it doesn't look as good compared to those other markets. Notably, volume was definitely above average at the start of the trading day, but by midday, that really tapered off. And now we're looking like we're going to close down about 6% from the 20-day average.
I mean, I guess my question also is the financial conditions being so loose, right? Are they loose enough for the Fed to have to rethink things or not? And I know that they're looking at the labor market and saying the labor market's telling us that we're tight enough. But then Kashkari, I feel like, opens a door crack to talk about if financial conditions are actually tight enough. And then you look at the meme stocks. That, to me, doesn't say tight financial conditions, guys.
Yeah, that's definitely going to be something that the Fed will have to debate. I agree. I'm not quite sure where this tightness is being viewed right now. But at least for today, definitely things are loose and everyone seems to be enjoying it. The clapping, the confetti, and the bells. The Dow Jones Industrial Average closing out the day up by more than 350 points, back above that 39.9 level, up about 0.9% here on the day, and that is a record high. The S&P with a fresh record high at 53.08, up 61 points or more than 1% on the day. The NASDAQ composite also up, extending to a fresh record high, up 231 points or 1.4%. The NASDAQ composite, we should point out, which was lagging, the NASDAQ 100, which was lagging the composite, also up 1.5% to a fresh record high. And there's your Russell 2000, not a record high, but still a pretty decent day, up 1.1%.
Pull out your 5,300 hats, if you will.
I got it.
Good to know. Good to know. Hey, S&P 500 folks, most names in the index higher today, 358 gaining ground today. Scarlett, 143 to the downside, 2 unchanged.
And it's a pretty simple story when you look at the sector performances. A lot of green there. Every single sector is not down. I point that out because consumer discretionary is unchanged, as is consumer staples. But tech is leading the way, up by 2.3% as a group.
All right, so let's get to some of the individual gainers. This has the S&P NASDAQ 100 close at their first record highs since March. Supermicrocomputer, number one gainer in the S&P 500, just finishing the day off its highs of the day. Still a gain of about 15.7% here, rallying on some heavy volume. I couldn't find really any significant catalyst or specific catalyst. I did see some buying of shares popping up on some of the 13F filings, which I know we're all keeping a watch on, but nonetheless, an outperformer in today's session. Let's go to BioCryst Pharmaceuticals. Ticker is BCRX. This too was an outperformer. It is a small cap, $1.3 billion market cap biotech, rallying on higher than average volume after at least 5 insiders, including the CEO, issued SEC filings saying that they bought more than $800,000 worth of the stock. This stock gaining almost 19% in today's session. I should point out some short covering had to be going on because it's about 70% of the float being shorted. So some of that going on. Petco, another one. WOOF is the ticker, and this one finishing just off its highs of the day, almost a 28% gain, jumping the most in more than 3 years. Again, heavy volume in this name. Positive market reaction to the company's appointment of Glenn Murphy as executive chair to lead the search for a new CEO. You know that there's been some changes here. The last CEO stepping down, I think that was in March. Ron Coughlin stepping down following several quarters of underperformance. Stock's down about 23% year to date. Again, short covering probably happening. Almost 40% of the float is shorted, so some of that going on, but nonetheless an outperformer today.
Before you move on to the decliner, I was just looking. There was 71 52-week highs in the S&P today, and quite a few of those were record highs as well.
Significant.
But, and it was pretty broad-based, too, because remember, every time we get these rallies, it's always just basically like the Mag 7 and a couple other stocks, but it's banks, it's semiconductors, it's material stocks. It's basically everything right now in the pool.
So tight financial conditions, question mark?
Exactly. Yes, good point.
Hey, I want to go to some of the decliners that I had my eye on today.
Where have you been, Tim, by the way?
Sorry?
Where have you been?
Oh, I've been doing some cycling in Colorado.
Okay.
I leave for 2 days and meme stocks go nuts. Is that what happens?
And then you come back. And then you come back and then they don't.
2021 all over again. It's kind of wild here. Before we get to the meme stocks, I do want to talk about Tesla. It did finish down 2% roughly today. A couple pieces of news that I'm keeping my eye on. The company must face a proposed class action lawsuit lawsuit that alleges it misled customers about its car's self-driving car capabilities. It's a setback for Tesla, just as Elon Musk has really staked the company's future on autonomy. We know that big unveil is coming in August. And then also NIO, the Chinese competitor to Tesla, is launching a more affordable brand in China that really takes aim at Tesla. Shares finishing down by 2% today. And now on to those meme stocks, because it seems like Keith Gill, aka Roaring Kitty, was pretty busy over the weekend with some social media posts that set off some buying, at least with AMC and GameStop. Those two companies were among the top 10 bought by retail investors on Tuesday, $51 million and $16 million daily inflows, according to data from Vanda. Today, we saw some selling, down 20% for AMC. The company did take advantage of that equity rally that we've seen in recent days through a private deal to reduce its debt. No fundamental news for GameStop, though, ticker GME, finishing down 19% today. Those shares have tripled in the last 2 weeks, but unlike AMC, it hasn't sold any stock. Like I said, it's meme stocks all over again.
Yeah, but you just gotta love AMC, CFO. Like, they got the job done. They're like, all right, let's do this. Like, here's our playbook. Taking a look at the bond market here, it was actually kind of exciting. Buying across the curve, you got a lot of buying in the 3 and the 5, so basically the belly. You have all the yields kind of really down below their 50-day moving average and either below or kissing their 200-day moving average. So some technical damage done on that level, Romain.
All right, Cisco earnings crossing the wire right now. Shares higher in after hours trading. The company looks like they have a beat on several key metrics here. Let's just walk you through the numbers here. For the most recent quarter, the company is saying revenue came in at about $12.7 billion. That's slightly higher than estimates. We should also point out that the adjusted EPS number also hitting targets as well. But the forecast appears to be why we're seeing the shares higher. For the full year, the company says revenue will be $53.6 to $53.8 billion. That's higher than what than the guidance it had given before. And the high end of that range is basically on the nose with what the street was looking for at around 53. Adjusted EPS, the full year forecast, guys, 369 to 371. That's kind of slightly tweaked to what they had before, which is 368 to 374. But the street was looking for 364. So again, the bottom end of this range would be higher than the average of analyst estimates. So a beat in the most recent quarter and guidance for the full year above estimates.
Yeah, stock, off about 2% year to date, but we are seeing a pop of about 4.5% in the aftermarket. Some commentary and context coming off of this release. Former Splunk CEO Gary Steele named president of go-to-market at Cisco effective immediately. Cisco Chief Customer and Partner Officer Jeff Sheretz will depart after a 24-year career at the company. And they also noted that the acquisition of Splunk had a negative impact of 1 cent to third quarter adjusted EPS. So getting a little bit more color in terms of the business there.
Yeah, and this was, of course, the first earnings report since Cisco closed the purchase of Splunk, which was really aimed at broadening out Cisco into a provider of networking services, not just a maker of networking gear. I'm also looking at the fourth quarter, that is this current quarter, fiscal fourth quarter, adjusted gross margin. It sees it at 66.5% to 67.5%. Analysts were looking for 67.4%. So at the high end, it certainly covers the consensus estimate, but at the low end, it would be below what analysts are looking for.
In comments ahead of that call, CEO Chuck Robbins touting the company's ability to bring together networking, security, observability, and data, which allows Cisco to offer customers unrivaled digital resilience for the AI era. I mean, this is a company that's been through many different generations of Silicon Valley, and the latest among them, of course, is the AI generation.
Yeah, certainly something that they've got in terms of a rethink of how their strategy is. All right, guys, continuing to see, though, that name higher in the aftermarket. Just a quick check up, about 4.4%. All right, that's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals, Beyond the Bell is what we call it. We will see you again, same time, same place tomorrow.
All right, stick with us here on The Close. Our coverage continues on Bloomberg Television with a look at GoodRx and Kroger announcing a refresh on their pact to bring lower-cost prescription drugs to the pharmacies in that Kroger network. A conversation up ahead with the CEO of GoodRx, Scott Wagner. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romain Bostic. And, well, Scarlett, we got a record high.
Record highs all around.
Yeah, now I guess I don't know. Who knows what comes next here. But I think the market has really been trying to push toward this, really just trying to find any excuse to bid prices back up. And we got that in bit of a way. I don't know if it was a big way, but you had a CPI report that at the very least did not disappoint. I thought Bruce Richards over at Marathon really put it best. This might have been a lot about folks being on the wrong side of that trade coming into today and having to course correct. An S&P 500 at 5,300, a fresh record high, a fresh record high for the Dow Jones Industrial Average, a fresh record high for the NASDAQ Composite and the NASDAQ 100. A big bump up in chip stocks as well here. And you take a look at the cross-asset space, Scarlett. Not a whole lot going on with the dollar. Still some concerns there, and actually a lot to talk about there with the yen and the real. But you take a look at yields right now, 4.72 on the 2-year. We also saw similar moves on the 10-year, and that has to be feeding in to some of the action we saw in equities.
Absolutely. Let's start with home builders. This is ITB. It's the ETF that tracks home builders. And as you can see, up 3.75% on the day. All 16 builders in S&P indexes closed higher. It was a knee-jerk reaction to the cooler inflation data, which could prompt a rate cut sooner rather than later, which would then be good news overall for the housing market. On the flip side, Disney, the worst performer in the Dow Industrials, losing as much as 3.8%, closing the day down about 2.5%. CEO Bob Iger is cutting marketing spending for the Disney Plus streaming service in order to meet its year-end profitability goal. He also gave a fairly tepid outlook for growth when it comes to subscriber numbers for the streaming service for this quarter. And he also said visits to the theme parks are seen moderating from post-COVID highs. Now, our top story this hour is what has the smart money been up to? We're going to get an idea from the first quarter 13F filings of hedge funds and other big name investors like Warren Buffett. Of particular interest, which tech companies money managers loaded up on versus dumped. NVIDIA led chip makers higher in the first 3 months of the year, while 2 of the Mag 7 names, we're talking Tesla and Apple, posted double-digit declines. So we'll see who put their money where. Romain? All
right, another big story we're following right now involves GoodRx, fresh off of its investor day and fresh off of a new pact with Kroger to expand access to prescription drugs. Scott Wagner is the interim CEO over at GoodRx, and he's standing by right now down at the NASDAQ market site here in New York City. Scott, first of all, before we get to the Kroger deal, I do want to talk about the investor day here. I mean, you have that interim tag, and it's there for a reason. This is a company that has had some growing pains here as a new public company and really trying to find that next leg of growth. What was the pitch today to investors?
Well, the pitch was describing in pretty clear detail the value that GoodRx provides, which is to get Americans access to affordable medication. And we spent some time showing why that is and that we really do fill the gaps where insurance doesn't, and laid out a pretty clear path for us to grow both in partnership with retail, a bunch of cool things we're doing with brand pharma, as well as plans that all layer into, a pretty nice return to growth for the business.
And that sort of leads us, I guess, to that deal with Kroger. You've had a relationship with Kroger, but this expands that or at least extends it here. Why is it important to have a partner, a brick and mortar partner like Kroger?
Well, Kroger is a fantastic retailer. It's one of the largest in the U.S. And is a leader in both healthcare, nutrition, and wellness. And what we really did today was kind of go hand in hand to renew our relationship and bring GoodRx back into Kroger. So we're super excited about it, and we think Kroger will be too.
It doesn't sound like this is an exclusive relationship either, which opens the door for you to create similar agreements with others. Is that something you're working on right now?
It is, and this actually is something that we have done with all the other big retailers. And so what you see today is us really rounding out our network so that if any of our 25 million customers or users of GoodRx present the GoodRx card at any retail pharmacy, it's going to be accepted. So it pretty much solidifies us everywhere that you need to get your prescriptions in the U.S.
As Romain mentioned earlier, you are hosting an investor day today. You hosted an investor day today. I'm curious to hear from you what kinds of questions you got from investors. What is their mindset in terms of what they're seeking right now? We know there's currently a bit of an obsession with income. Everyone's looking for their equity investments to generate income. What did you hear from them that might affect how you think about returning cash to shareholders?
Yeah, two big themes of questions, one of which was for us at GoodRx, what are the simple pieces of growth? And for us, it's 3 things of partnership with retail and a whole bunch of things with brands that we're doing, as well as with payers that, frankly, we see us on a trajectory to over $1 billion of revenue and 35% profitability by 2026. The other theme of questions, honestly, they relate to things like GLP-1s that, not surprisingly, are on everybody's mind and offers both a ton of opportunity, not just for us, but for everybody in the system that gets people access to medication easily and affordably.
So talk to us a little bit here, Scott, about this idea of competition. And I asked your predecessor that every time he came on the program, I would always ask him this question about the Amazons and these other behemoths that are trying to basically do exactly what you do here. And I don't understand, and forgive me if this sounds flippant, why you aren't worried.
Gosh, maybe not we aren't worried, but at least have confidence in what we do. Okay. And I'd answer that first, which is we really do have a value proposition that matters a lot. 25 million people a year use us. We fulfill on 100 million scripts, have the super high net promoter score. We matter. Now, to other people like Amazon, yeah, Amazon has a direct mail component. They're certainly a big deal. And, it puts pressure on the entire system that actually is a good thing in terms of affordability, because anything that puts some focus around affordability, we think is going to help us. And while we don't work with Amazon directly today, we're all about giving people access to different choices and medications. So who's to say that can't change in the future?
I want to go back to something you said about GLP-1 and how that was definitely a focus for investors. We know that different drug companies are looking to create their own version of weight loss drugs. At what point, what's the tipping point where we start to see pricing on these GLP-1 and similar drugs start to become more affordable, something that is more accessible to the broader public?
Yeah, I think we're going to see that play out certainly over the next quarters, but probably years. Right now, there's two big companies that are producing GLP-1s. If we flash forward 3 or 5 years from now, boy, there's probably going to be a dozen different kinds of brands in the market. And as you have a dozen different kind of GLP-1s, you're probably going to see an evolution that makes it look a lot more like a consumer product where people market, they have different price points. And that'll probably happen over time as both new brands enter the market and the evolution goes to more and more competition.
All right, Scott, really appreciate you taking time for us. Scott Wagner there, the CEO of GoodRx. And let's stay in the healthcare space here because one of the most read stories on the Bloomberg terminal, it involves the demise of 23andMe. Maybe not quite the demise, but certainly the demise of all the hype around DNA testing. Kristen Brown joining us right now, the reporter on that story, to talk a little bit more about what happened. These things were everywhere for a moment in time. And not just 23andMe. We shouldn't just pick on them. There were a lot of other companies doing these genetic tests that were supposed to reveal everything about us and I guess maybe potentially figure out if we had propensity to certain diseases or other things like that. Were they not doing that?
My favorite test of that era, of the really bubbly era, was actually one that you took the test and then it told you what kind of wine you should drink.
Really?
Yeah, based on your preferences.
I missed that one.
But yeah, so I think...
Or they could just ask us.
They could just ask you, right? I think I could tell. So I think that, when we first sequenced the human genome around 20 years ago, there was all this promise. We really thought that it was going to be like, oh, here's the gene for diabetes. Here's the one gene for heart disease. And as we got into it and started learning more about the science, it became so much more complicated. For heart disease, there are so many genes that can impact the health of your heart, and we don't even know how they all work, how they all connect. And so I think when companies like 23andMe came online, there was still that thinking that it was going to be simple, and then it wound up not being simple.
Why did they think that? Because I remember seeing an interview with one of the folks who was behind the original mapping of the human genome way back when. I'm going to date myself. But he even said something similar to that. That basically once they unlocked this, they realized how interconnected everything was. And it really wasn't just about looking at one gene. But he said that long before all these testing kits came about.
Yeah, I think it's a classic science story where we always think it's going to be simple. And then I think once they realized it was going to be complicated, they still didn't realize just how complicated it would be. So we've just had this snowball effect where it just keeps becoming more and more complicated. And we always think we're sort of on the precipice. And if you ask 23andMe today, I think they would still tell you that we're on the precipice of unlocking all this value. And it just, it keeps getting kicked down the line.
And maybe one day it will be, but by then, 23andMe may have run out of time. The company is at risk of being delisted from the NASDAQ right now.
Yeah, so back in November, they got a letter from NASDAQ saying, you got to get that share price up. And on May 10th, they actually just got an extension. So they have until November to get their share price back up above $1 again. Otherwise, they will be delisted. But at the current moment, it looks like one way to get around that might be that the CEO, Anne Wojcicki, has filed an intent to take the company private again herself.
Yeah, I saw that. This is a fascinating read. I really encourage everyone to read it. It's in the new edition of Bloomberg Business Week by Kristen Brown. 23andMe's fall exposes DNA testing as more gimmick than remedy. All right, another story that we're following right now crossing the Bloomberg wire is AT&T and AST Space Mobile. It's a small company, AST Space, but it's rallying 50% here on the back of news that AT&T is planning to move forward with a plan to challenge Elon Musk's SpaceX internet service. This will be a wireless service sort of beamed by satellites. It's going to be called Space Mobile. And we should point out, Scarlett, AT&T has been working with AST on this for a while now, but now they've entered into a formal partnership that runs through at least 2030 here. Obviously, this is a much bigger deal for a smaller company like AST, but it also means that potentially you could see a potential viable challenger to Starlink.
So if I have AT&T broadband and it doesn't work and I call them, they're going to blame it on a space satellite? Is that what's going to happen here?
Do they actually have people manning those calls? I'm pretty sure you're just going to get an AI bot.
Yeah, that's true. So the AI bot's not going to be able to answer and say, come back later.
Yeah, the technology, though, is fascinating. I mean, anyone who's used Starlink could tell you the technology is fascinating. And, of course, there's been a lot of people lamenting that there aren't other options out there.
So Elon Musk was the only.
So maybe this is AT&T, so we'll see how this goes. But nevertheless, you see the benefit there, at least for AST Space Mobile, up 60% here in after-hours trading. When we come back after their break, a look at 13F season. This is The Close on Bloomberg.
Today is the deadline for 13F filings for the first quarter. So if you go on your Bloomberg and you type 13F, NI13F, it's a ton of stories crossing the wire. Bloomberg's Shonali Basak has been keeping an eye on all those wire stories and, of course, the big hedge funds and stock pickers. Shonali, what jumps out at you? What surprises you in some of these 13F filings?
Well, when you see these 13Fs cross, one of the biggest set of investors you go to are the Tiger Cubs, active traders, and certainly very active this time around. And you think about Coatue, for example, selling out of 30 positions, but taking 21 new ones. And so a lot of trading going on here. We think of them as acting as somewhat of a herd in big tech names and semi names. But this time around, semiconductors, I think, were among the most interesting trades because you did see them reduce some positions, perhaps taking some profits. Remember, we're talking about the first quarter here, end of March. Yeah. So some of this information is, of course, very dated. But we try to get this to get a sense of where they're going. So what does this mean exactly? You have, for example, Coatue increasing Alphabet and Amazon, but reducing exposure to NVIDIA, for example. Yeah. And others, you see similar kind of repositioning among those semis.
I know it's hard to know exactly the motives behind these trades. I mean, we don't know the motives at all. But, I mean, that's never going to stop us from speculating, Shonali. But I am curious, but when we start to see the flip-flop, because I was going through some of these, and you see sort of a trade for one tech stock for another tech stock. Yeah. And I wonder if this is still kind of that AI play that everyone jumped into the pool at the end of the previous quarter into a lot of those AI stocks, which were primarily the NVIDIAs and the chip stocks. And now they've moved on to software and some other things that they still think might be AI plays.
You know, it's interesting that you bring that up because you see that even among the way that the sell side is approaching this. David Kostin yesterday put out a note with a great chart underneath it that put the correlations of the different technology companies to NVIDIA. And the implication there is that you want less correlation. Yeah. And so, yes, you did.
Not to brag, but we have that on the Bloomberg terminal, too. You know, you can just run the SPLC function. But David Kostin's great. So,
you know what? I did not know that function. I'll give you another one, though. FLNG Go, to figure out what all these guys are trading now. And it's interesting because, to your point here, some of them, you know, let's use Coatue as an example again. They increased Alphabet and Alibaba, but they sold out of other large names. They reduced AMD and NVIDIA. So you see what your storyline is here playing out in code 2s.
Yeah.
You know, another
Do you
thematic.
get excited about this stuff? About
I
the
do.
13Fs? Yeah, me too. I mean, everyone poo-poos it because it's always like, you know, you're looking back in time, like 45 days, but you learn a lot.
You learn a lot, not just about what they're buying, but also, for example, sometimes you learn more about what they're selling. Back to code 2, one big interesting set of things they sold were Tesla Rivian, for example, and Viking getting into U.S. Bancorp Financials, KKR, and Eli Lilly. You see that healthcare trade.
All right, Sonali Basak there. A nice run through of those 13F filings. Got it in right there on time. When we come back, a look at Apple and the retail stores. All right, on this day, May 15, 2001, Apple began a major shift in how the company connected with its customer. Steve Jobs on that day publicly provided details of plans to sell Mac computers directly through Apple-owned retail stores. It was an expansion away from a sales strategy that had up to then been heavily reliant on third-party retailers like Circuit City, Sears, and CompUSA. But legend has it that Jobs was frustrated with the retail partnerships and what he viewed as inadequate visibility of Apple products inside those stores and staff members that weren't experienced enough or enthusiastic enough to showcase the technology. At the time, Apple only had less than 5% of the U.S. computer market, and Jobs said that the company's own research showed the other 95% didn't even give Apple products a second thought. Jobs even griped at the Macworld trade show in January of that year that, quote, buying a car is no longer the worst purchasing experience. Buying a computer is number one. Of course, that somewhat audacious comment and even more audacious solution for Apple to have its own retail footprint was met with quite a few raised eyebrows. Competing computer maker Gateway had already embarked on a similar brick and mortar strategy that ultimately struggled under the high overhead expenses, inventory levels, and logistical needs to maintain a nationwide retail network. And a lot of the electronic superstores that Apple was partnering with, they were struggling with the breakdown in their business models. CompUSA, Circuit City, go find one now. But as we know, Steve Jobs was not one to be denied. For at least 2 years prior to that announcement, Jobs had already been working quietly with current and former executives from The Gap, Target, and Victoria's Secret to help make this retail strategy a reality. And that brings us to our question of the day. Where were the first two Apple stores located? The answer? In the posh Washington, D.C. suburb of McLean, Virginia, and in the Los Angeles suburb of Glendale, California. It started with two. Those stores, which opened 4 days after the May 15th announcement, were cavernous, despite the fact that Apple only had 4 product lines at the time. Remember, this was 6 years before the iPhone era even began and 9 years before the introduction of the iPad. So the stores were pretty much just arranged around Mac computers in the front quarter of the store, with the rest of the square footage devoted to software, accessories, and then services like that theater for educational programs or the Genius Bar where you can get your computer repaired. In May of that year, Bloomberg Business Week published a headline that said, "Sorry, Steve, here's why Apple stores won't work." Now, that article proved to be terribly misguided in hindsight, focusing heavily on sales. But ultimately, the stores were much more about the presentation of Apple products rather than the hard sell itself. In fact, Steve Jobs said that himself. He said the product was not the most important thing here, and that may be why the stores proved so successful. They were stylish, with comfortable, minimalist surroundings on the inside and creative architecture on the outside that was less brick and mortar and more glass and sandstone. It was all part of an aesthetic, a vibe that crafted an image of a company that was selling a lifestyle, selling an ethos, selling street cred, if you will. And it was an image that fueled the growth to more than 500 stores today, and it has fueled sales growth at that company for 23 years and counting.
It's also a place for people to charge their phones for free without anyone bothering them to leave, which makes it very attractive for those with kids who want to play the games on those phones as well. Great stuff, Romain. Well, let's continue the conversation here on things you do on your Apple devices, such as checking out social media like TikTok. Content creators that rely on TikTok to express themselves and also run their businesses are pushing back against the U.S. government's divest or ban bill. A group of 8 influencers filed a lawsuit on Tuesday claiming that the ultimatum presented to TikTok violates the First Amendment. The Justice Department had no immediate comment, but has said in the past that it looks forward to defending the law in court. Let's get firsthand perspective about the suit from those involved. Brian Firebaugh is the founder of The Cattle Guy. You can see he's the one in the middle there. And Paul Tran is the co-founder of Love and Pebble. Gentlemen, thank you so much for joining us today. Let me start with you, Brian. What was it about this lawsuit that prompted you to say, yeah, I'm in on this? Because you are all over social media. Certainly TikTok is not your only platform. You're on Instagram, you're on YouTube. Why does TikTok matter more than the others?
Very, very short. It's 100% of my customer base were derived directly from TikTok. And for that reason, it just became the paramount platform for us. So when you talk about pulling that out, you're basically pulling away 100% of my customer base.
And what about you, Paul? Because you are co-founder of Love and Pebble. It's a skincare line. Clearly, you are able to, I'm sure you've diversified and use several platforms and don't rely on TikTok on its own.
Yeah, well, actually, 90% of our sales are on TikTok Shop. So we actually found a lot of success on TikTok. We actually launched our product, the Beauty Pops. It's a product that we launched, and from TikTok itself, it's gotten us sales, but not only that, but PR mentions. It's gotten us on Shark Tank and all these other mainstream things. So we rely heavily to have our voice heard on TikTok.
I am curious, though, Paul, when you look at the ban, assuming that it does come, but even just the talk of it, it's put a chill over a lot of things here. Does it get to a point where, regardless of where this goes, you have to start making a pivot now to, I guess, protect your presence and, more importantly, protect your brand? Or is it too early?
I mean, the skincare industry is hard in general, right? It's just us kind of starting over would be very, very disappointing, right? The skincare industry in itself is just like so hard to get into. So, I mean, do you have to look? I think you do, but we found success. We found a home. We found an audience that I don't think we could necessarily find on other platforms, or we haven't been able to. So that's the concern that I have with this ban.
So I'm curious, Brian, just from your perspective here and how you yourself have used it and the popularity you've gotten off of it here. What do you really want to accomplish with this lawsuit? Meaning, we know that the government, the U.S. government, is going to push hard on this one way or another. Something will probably change, whether it's a full divestment or not, who knows. But what would be ideal for you?
What would be ideal for me is if we had our lawmakers that slowed down for just a second. Instead of just trying to punish one app, let's try and punish the behavior. I would like to see sweeping laws to try and protect, our data. Try and protect, the sanctity of, Americans on social media. And so I would like to see it in that aspect, because a lot of what they talk about is the fear of it's a national security threat having this app. But the problem is that they've showed us absolutely zero evidence of it. And if that was the case, then why is it that we have the Biden administration actively campaigning with an account on this app? If we're honestly fearful of national security, then let's embark and throw laws out there that help protect our national security and help protect against the behavior that they're so afraid of.
If you could clarify for us, Brian, how exactly do you make money through TikTok? Because we know that there's a lot of emphasis on sponsorship deals where you're sponsored by someone to create a story or video for them. But is it on commission on sales? Talk us through the intricacies here.
For instance, there was a gentleman that saw one of my TikTok videos just yesterday, and he saw a couple cows in the background that he really, really liked. He reached out to me and he said, "Are those cows for sale by chance?" Absolutely. He's coming tomorrow to pick up 5 cows for me. He specifically saw those cattle on TikTok because of the following that I had, saw them behind me and reached out to me. Unfortunately, he did not see those cattle on Facebook or Instagram. Let's face it, Facebook is archaic, it's dead. Instagram's prime was more than 7 years ago. This is the #1 platform in the world right now, and this is where a number of our customers are coming from.
Are you going to pay TikTok a commission if you sell the cattle to this guy?
Absolutely not. I need that to provide for my family. That's why this is so huge and such a big deal to me. Is we're not only talking about the freedom of, expression, the freedom just to go ahead and build communities and share within ourselves, but we're actively talking about being able to provide for our families. There's over 70 million small business owners like Mr. trend there that is relying on this app for this success in order to provide for their families. And if you actively strip this away, you are stripping away funds from 70 million different small businesses, and it directly impacts our families and our way of life.
Paul, I want to get your thoughts on this. You probably haven't sold a cow on TikTok, but you certainly sold some beauty products here. I mean, what is the partnership, though, like working with them? I mean, I think Brian kind of brings up a good point here with regards to the other social media platforms in terms of just their relevance and, more importantly, the way that they work with content creators. Explain how TikTok worked with you guys.
Yeah, I think that's the main secret to TikTok. It's not only just us posting our content, pushing ads, and getting paid media behind it. We actually partner with a lot of affiliates on the platform. So over the summer last year, I think we had 20 creators, and then it exploded our sales to the point where we ran out of stock like 3 times.
Wow.
To date, we have about 2,000 affiliates that we partner with, and that's the secret of TikTok, right? So we're partnering with them. They're selling our products. We pay them commission. It's a symbiotic relationship, but we're able to get in front of people, in front of their audience that we never would have been able to before. And that's where the power of TikTok is. Not just a social media platform where people are mindlessly looking. We're really interacting with people on the platform.
Got it. Paul Tran of Love and Pebble, thank you so much. Brian Firebaugh of The Cattle Guy. Both of the gentlemen here are among a group of 8 influencers filing a lawsuit on Tuesday against the U.S. government's divest or ban bill when it comes to TikTok.
Now, have you ever bought anything from either one of these guys?
I've gone on TikTok. I've not purchased anything. I don't need to buy a cow.
No cows.
No cows.
You can buy like a whole cow. You can buy a whole cow, and just, I don't know if you eat meat, but
I eat meat, but I don't need a cow.
Okay, but you need beauty products.
Yes, beauty products I might take a look at. All right, let's take a look at markets. Record highs all around. Dow, S&P, NASDAQ,
to the markets, Scarlett.
NASDAQ 100, it's in the markets. There's no check on beef prices here, but we do have oil prices rising more than 1%. Dollar weaker, a rally in bonds as well. This is the close. Actor Miles Teller is helping to bring the taste of Finland to the U.S. He is a part owner of The Long Drink. It's a fruity carbonated alcoholic beverage. We spoke with him and co-founder Evan Burns about the origins of their partnership.
I was up in New York and I was just kind of walking around, and I happened to walk into a liquor store where these guys were doing a tasting of Long Drink. And this was very early days for them. I think this was in 2018 or 19, and I just tried it, and I thought it tasted like nothing else that I'd ever had. And so then when I got home, I was able to get a contact and kind of told those guys how much I loved it and if they could keep sending me some. And I felt like I got enough free drinks at that point. And I said, hey, we should sit down and, let's talk about doing a partnership with this. So it was very organic.
I love the fact that you sought them out. You have praised, Miles, the Finnish Long Drink's authentic backstory. What specifically about the history of this drink really appealed to you?
For me, I just love when there's just such a pride in a product, and a country like Finland, who certainly has provided a lot of products that have grown on the global stage. I just really felt I really fell in love with the culture over there, and the fact that when we went over there, I wasn't sure what the reception would be because we were taking their national beverage and bringing it to the U.S., but they were really excited about it. And I think that kind of enthusiasm made it feel, it just made it feel good. We certainly didn't want to feel like we were taking a beloved product and kind of putting a not a great spin on it, but the proof is in the pudding, as they say. And when the Finnish, when they've tried it, they've given us the seal of approval, which goes a long way.
Well, that's what I'm curious about, Evan, too, kind of the translation of this product from what was really kind of core to Finnish culture and sort of expanding that out to cultures that, let's face it, a lot of us didn't really have familiarity with what a long drink was, even though it is pretty simple once you actually learn what it is. But what was the process that you went through in your head when you thought, how do I sort of take this as a brand and build it in a country and in markets that previously had little or no familiarity with it?
Yeah, it's a great question. Miles and I have three partners that are Finnish that live between Finland and America that started this with us. And when they really helped us learn about this product that was commissioned by the government for the Olympics in the 1950s, it really got us excited. And of course, when we tried it, we're like, man, this is something really, really special. So we didn't really change a lot. We brought the same taste profile, the same story to the American public. In fact, Miles and I were talking about it. We were on Bloomberg TV 3 years ago in 2021 announcing an investment then. And we were joking because we had said that we had sold 3 million cans in America in the past year or so. And we were looking today and we had sold like 100 million cans in the past 15 or 16 months. So it's been really cool to see Americans get as excited about this as really the Finns seem to be.
And we should point out, when you say started at the Olympics, they weren't drinking this at the Olympics as like the athletes, right? These were the people on the sidelines, I assume, right?
Maybe athletes.
But 80% of the gold medal winners were drunk on long drink.
All right. Well, I'm not sure I believe that, Miles, but that is a great story. And I think it's kind of fun the way you guys have put this brand together. I am curious, though, about the investments in this, Evan. I mean, obviously, you were able to sell Miles simply what effectively seemed like an impromptu taste test here in New York. You've got Marcy Venture Partners involved in this, which knows a thing or two about building liquor and spirits brands here. When you look for money and you look for partners, more importantly here, what is most important? What do you want from those folks beyond money?
Yeah. When we weren't actually looking to raise money last year, and the folks at Marcy obviously have a tremendous history of building great alcohol brands. I think Ace of Spades Champagne's been an amazing one. And so the partners came to us and said, look, we really love the taste. We love the story, same reasons that we got involved. And they really convinced us that this is a really early stage brand. Even though we only have 1 or 2% of Americans who know what it is, they said, look, let us get involved. Let us put some capital in and let us really help grow this brand from something that a lot of Americans love and to build into an everyday kind of known in every house type of brand. So we're doing really well before it, and we were excited to have them kind of come and help us on that journey.
Miles, you increased your investment in the company last year, and of course, Marcy Venture Partners is part of this. I wonder how their presence in the company changes your role in any way.
Well, I don't think it necessarily changes my role. I've really enjoyed any time we've kind of brought a new member to the team. It's been something that I've been really excited to get to know them and talk to them. And I think for them, it's, look, I'm pretty easy. I'm like, I genuinely really enjoy this product. I want as many people as I can to find out about it. It's been, to me, those are my favorite experiences with this brand is kind of getting out there with the people and just, having them try it if they haven't tried it and just seeing the excitement around it. I mean, this thing really started in such a small space, and now it's really being celebrated across the country. So I'm looking forward to it. There's really sharp people over there, and I'm ready to work with them.
I am curious too about the lineup here. I mean, I was going through it. You have the citrus flavor, you have peach, you have cranberry. That's it. I mean, that's pretty targeted here. Are there any plans to expand the flavor profile, or are you finding that this sort of narrow offering is a better process, if you will, in getting adoption?
Well, if you look in Finland, actually, the citrus flavor profile makes up well over 90% of the consumption that happens in the country. So for us, the first job is to take that traditional flavor profile that's been around for decades and bring that to Americans. And of course, as they get to know about it, it's fun to bring more flavors that we think Americans would like. But the main focus is really on citrus flavor profile, and we have a zero sugar version of that. And also, I think one of Miles's favorites, we have an 8.5% version also. It seems to be loved by golfers also a lot.
8.5% alcohol content.
Yeah.
Oh, okay.
The standard is 5.5%, but there's also 8.5% one.
Okay, I've learned a lot about Miles in the past 8 minutes here. So another question, though, too, and this is really just kind of on the future of this company. I mean, you've built it up. The awareness is pretty strong. You have great investors here. There's a lot of questions now about whether you stay as an independent company. Are there plans for any sort of M&A deals? Are there any plans to go public? What do you want to do with this company next?
Yeah, we talk about it a lot. I mean, we think the company is really at an early stage right now. We're happy that so many people do like the product. We're happy it's available in 45,000 places across the country, most of the major chains, but there's a lot of upside still. And we're looking at some other international markets, but even the US, if we have only 1-2% of people that know about it, there's a lot of marketing we can do and a lot of buzz we can create to bring the product to as widely known to most Americans as it is in Finland too. And I think that's the main focus for the next several years.
All right, Miles Teller and Evan Burns, they're partners in the long drink, Scarlett, basically an alcoholic beverage. It's kind of a spin on the Finnish long drink, which is basically just gin and grapefruit juice, but they've kind of put their own spin and brought it here to America.
Yeah, it sounds really good. I like anything citrusy.
All right, well, we got to set a date here and go out and try this out in the wild. In the meantime, we'll set you up for what to watch over the next 24 hours. Stick with us. This is The Close on Bloomberg. Here's what to watch tomorrow, and includes earnings out of Walmart. Jen Bartash is joining us, senior analyst for Bloomberg Intelligence. And Jen, I was taking a look at the Bloomberg estimates here, something like 3.5% growth year over year, 10% on a 2-year basis. What's actually driving that growth?
Well, really, it's a combination of things. It's value-seeking customers, and it's trade down from some of the higher income households that have really started to shop at Walmart in the last 12 to 18 months.
Yeah, but if you look at gross margin, there's a lot of expectation that Walmart will be able to expand that. Specifically, what's driving that confidence that Walmart can drive that profitability as well?
Well, it's twofold. One is that Walmart really is a very, very cost-focused company, and so they're very good at keeping costs controlled. And I think evidence of that comes from some of the announcements in the last couple of weeks between cutting corporate headquarter jobs, closing down the healthcare clinics, that sort of thing. But in addition to that, they've also been investing in things that generate higher margin revenue. So that would be advertising revenue. Things like that then come in and help bolster that gross margin up, and it makes it a reasonable expectation that it should expand, even if just slightly, this quarter.
What's the one big thing you want to hear tomorrow on the conference call?
I think what everyone's looking for is that read on the American consumer. By all standards, Walmart touches more consumers than any other retailer out there. So understanding what they're seeing in terms of spending behavior, are people going back into discretionary categories? Are they still staying conservative? That'll be a big read-through for the rest of the industry.
Jennifer Bartash is over at Bloomberg Intelligence. A nice preview of the Walmart earnings, which you get tomorrow morning. A few other things to keep an eye out on. NATO military chiefs are meeting in Brussels.
And Ukraine will definitely be on the agenda. There's also JP Morgan Global Markets Conference with Jamie Dimon, of course, speaking, and we'll have an interview with him.
We also get more earnings, including Walmart. We're going to get Under Armour as well as Take-Two, the video game company.
Yeah, when are they going to release Grand Theft Auto number 6?
I'm going to say 2066. How about that? Who knows? Never, Scarlett. And we also get Fed Speak, and I know everyone loves the Fed Speak. We're going to hear from Michael Barr and a few other folks as well.
Yeah, the FDIC chair, Michael Barr, of course, testifying on the oversight of financial regulators, but Fed Speak in the wake of the cooler than expected inflation report should be interesting.
Yeah, absolutely here. And we'll have full coverage of that right here on Bloomberg Television. We'll be back tomorrow, Scarlett and I, here on The Close. In the meantime, stick around. Balance of Power is up next, right here on Bloomberg.